The housing market is stuck. The housing market is dead. What in the world is going on? There is a lot going on in the national economy and in the real estate space. The Fed funds rate keeps going up, mortgage interest rates keep going up, PPI and CPI inflation numbers keep going up, and now Fannie Mae predicts home sales will go down 21% next year and housing prices will fall 1.5%. And that's just the good news. During these transitory times, it's about time that we try to understand what's happening in the economy and how that impacts the national real estate market and the real estate market here in the greater Chattanooga, Tennessee area. Hi, this is Robert C. Baker with United Real Estate Experts, and on this channel we talk about everything related to real estate in the greater Chattanooga, Tennessee area. And before we get into it, go ahead and click the like button, subscribe to the channel, and hit that notification bell. Thank you. You know, the flood of information coming out the past 2 weeks has been absolutely breathtaking. Black Knight announced that median home prices had fallen 2 months in a row. Stay tuned, we'll get into Chattanooga's median home prices in just a moment. July and August 2022 marked the largest single-month price declines seen since January 2009 and rank among the 8th largest on record. The monthly rate of home price decline is now rivaling that seen during the Great Recession. The question is how long it will continue to do so and how far off peak prices will fall. And if that weren't all, U.S. equities are pointing to a recession, but you knew about that already. And this week, the Producer Price Index, or PPI, came in hot. The Consumer Price Index, or CPI, came in hot, with core inflation the highest it's been in 40 years. What's going on? Well, there are a number of features, but suffice it to say that the combination of cheap money, the coronavirus crisis, the government's overreaction to the coronavirus crisis, the government handing out money like it was Halloween candy, supply chain issues and bottlenecks, and now the U.S. Federal Reserve trying to undo what it did years ago with super low Fed funds rate and quantitative easing, namely by jacking up the Fed funds rate and quantitative tightening. And all that has the markets, including the real estate market, not only here in the US but also abroad, in turmoil. Here's a cute cat video to explain. Seriously, we're in a strange place, and for the national and local real estate markets, there are going to be medium and long-term effects that you need to be aware of and be prepared for, especially if you're thinking about buying or selling or investing in real estate. Now, during this time, you're going to see a lot of stuff coming from folks in the real estate and mortgage lending industries who are acutely aware that this real estate market transition is going to hit them squarely in the pocketbook. In fact, just recently, I came upon a new Substack called Gritty Real Estate by Philly real estate agent Kira Mason. Hey, Kira. Now, be sure to go follow Kira on Substack. But what Kira was talking about in her piece is that there's an entire industry selling prepackaged information to folks in the real estate industry. Let's think infographics here, which share a certain perspective about the real estate market. Here's Kira. The purpose of the content these companies offer is not to educate the general public so that they might make wise decisions that are in tune with current market conditions. It is rather to keep consumer confidence high so that they continue paying the bills of their agents, who will in turn continue paying for content. Eventually, these companies have no choice but to come around and give lip service to what's actually going on, but it's always sugar-coated and always way too late. Having a finance degree myself and having worked in international banking, I've noticed the same thing. You, the real estate consumer, get pretty prepackaged truth bombs, basically full-color charts or graphs, thrown at you on social media with hardly any commentary and little context. Well, there is a subcontext, and that's either sell, or buy, or borrow. I mean, I get it. People need to put food on the table, but especially in times like these, consumers need less, not more of that. Okay, off my soapbox. What we do need are data and facts. And the facts are that we can anticipate the U.S. Federal Reserve to continue raising the Fed funds rate at least 75 basis points, perhaps even 100 basis points at its next meeting. And we can further anticipate that we'll continue to see upward spikes in the U.S. 10-year Treasury rates, which closely correlates with a 30-year mortgage interest rate. And what does that mean? Mortgage interest rates are going to remain high for some time. And this brings us to Fannie Mae. In case you don't know, Fannie Mae is the Federal National Mortgage Association. It is a government-sponsored enterprise which supports the secondary mortgage market. It makes mortgages possible for low and moderate income borrowers. Fannie Mae does not make loans directly to borrowers, but it purchases loans those borrowers have made with smaller banks or credit unions and guarantees them through the secondary mortgage market. It makes those loans possible. And notice the headline in their October 12 release. Economy expected to contract further in 2023 as the Fed appears resolved to tame inflation. The Fed is serious, folks, about getting inflation down, and that's going to hurt. The combination of high inflation, monetary policy tightening, and a slowing housing market is still projected to tip the economy into a modest recession in the first quarter of 2023, according to the October 2022 commentary from the Fannie Mae Economic and Strategic Research Group. The ESG group expects home price declines of 1.5% in 2023, down from its previous prediction of home price growth of 4.4% in 2023. Looking ahead to the full year 2023, on a national basis, we expect an average home price decline of 1.5%. Given the ongoing tension between potential home buyers and home sellers at the moment, we believe the pace of sales is likely to slow even further too. Looking at their chart, we can see Fannie Mae's prediction of a 20.8% decline in home sales in 2023. That's highlighted in red. And in teal, we can see their quarterly and annual predictions of where 30-year mortgage interest rates will be next year as well. From a peak of 6.7% for the last quarter of this year, Fannie Mae predicts we'll see a gradual decline, all in the sixes, each quarter, ending at 6.4% for the year. Now, Moody's anticipates that mortgage interest rates will be about the same. Heading into the spring 2023 buying season, Fortune reports, Moody's expects mortgage rates to float around 6.5%. And if that weren't enough, I recently discovered Dr. Raman Nakisa, who runs a UK company called Pensioncraft, and who also has an excellent YouTube channel by the same name. And in a recent video, Dr. Nakisa extrapolates from the US Federal Reserve dot plots coming out of the most recent FOMC meeting. First, Dr. Nakisa derives nominal GDP, which is a strong correlation with the 30-year rate, by adding the Fed's real GDP projections to the Fed's anticipated inflation number. So for 2023, you'll see a 1.2% change in real GDP added to the 2.8% anticipated PCE inflation, giving us a nominal GDP growth rate of about 4%. Plugged into Dr. Nakisa's model, which is explained in this video, and adding 1.9 or 2% gives you the 30-year mortgage rate. And here, based on Dr. Nakisa's analysis, we've got 5.9% for 2023, which is just slightly less than Fannie Mae and Moody's. If inflation numbers keep coming in hot, I suspect in future installments of the Fed's dot plot, we'll see some revisions, which will of course change the mortgage rates projections. In any case, it should be clear based on these resources that most likely we're not looking at any significant declines in the 30-year mortgage interest rate in 2023. Now, what does this all mean for you as the consumer? It means this. As I've mentioned before, folks buy, sell, and invest in real estate during all economic situations. But this data suggests that if you plan to buy in the coming year, you need to be aware that interest rates are not likely to go down. Whatever interest rate your mortgage lender quotes you is the interest rate for you based on your own credit situation. Now, let's say that if Fannie Mae and Moody's are correct that the 30-year will be somewhere near 6.4 or 6.5% next year, depending on your credit score, you need to be comfortable with that and not buy a house in anticipation that rates are going to go down. Now, there are some programs, say, such as a rate buy down, where you can lower your rate the first year or the first couple of years. Speak to your lender about that. But before signing on to such a program, do know that we don't know where rates are going to go that second or third year. If Dr. Nakisa's numbers are right, based on the Fed's own projections, we could see interest rates at least near 6% for the next several years. And if you buy a house at 6% that has been reduced temporarily to 5%, and if you can only afford paying the monthly mortgage payments based on 5%, you're basically gambling that rates are going to go down, and you may be in serious financial trouble that second or third year. Just saying. So let's shift just a bit and talk about what's going on here locally. I'm not going to focus on the standard infographic information that you may be accustomed to. Rather, I'm going to focus on two charts which have been derived from info provided by our Greater Chattanooga Realtors MLS, or the Multiple Listing Service. Besides rising interest rates and affordability issues, and affordability has really gone into the toilet, we need to concern ourselves with home prices and where home prices are going. A lot of folks, my clients included, have bought homes during the past couple of years when home prices in the Greater Chattanooga, Tennessee area have skyrocketed just like they have everywhere else. And here I've created a bar chart to show you just how much median prices have gone up since 2017, 2 years before the pandemic hit. And you'll notice that there's a relative consistency in 2017, 2018, and 2019. Gradual increases each year, seasonal price fluctuations such as prices going up in the spring and tapering off in the fall. But lo and behold, cheap money comes along, and along with that, a strange behavior in median prices. The situation is not coming from the pandemic, but rather from super low interest rates. As folks were afraid of missing out, rush in to purchase just about any property they could find, even if they were in competition with a lot of other folks. So long about June or July 2020, we begin to see median sales prices go up quite rapidly. You can see how from July to August, that's the gold or yellow bar there, there's a dramatic rise in the median sales price unlike other years in the greater Chattanooga, Tennessee area market. And while median sales prices go up and down the rest of the year, they're higher than the year before. The median sales price picks up the next year, the blue bar is for 2021, and we see that it hits its peak in June 2021. And the median sales price rises even more dramatically this year in 2022. That's the green bar. Notice that we hit the peak in June. June or July is typically the months during which median sales prices peak in our area. But in June 2022, we had the median sales price at $328,000, which is the highest it's ever been. Now you can see that prices have fluctuated back and forth since July. There was a very interesting blip to $306,000 in September, and I suspect that that may be revised downward. Then October's figure is based on the first 2 weeks in October when this video was published. We're back at $300,000. Now typically when you look at the median sales price in the greater Chattanooga, Tennessee area during the month, let's say 2 weeks in, that initial figure is going to be high, then it's going to come down by the end of the month. I've looked at that several months in a row, probably 3 or 4 months, and without fail, whatever the initial reading is, after those first couple of weeks, the number always seems to come down by the end of the month. However, this time it's $300,000. Now perhaps we have an anomaly here, perhaps it's not going to come down, maybe it's going to go up, I don't know, but it is somewhat curious that it's at $300,000 for the first 2 weeks in October, which is what it was in August and in March of this year. So it's almost like there's something holding back that median sales price figure, and I suspect that it is a softening of prices, a softening of home values. The second chart I'd like you to look at is the sold to original list price ratio for the greater Chattanooga, Tennessee area. Now in this chart, I go back to 2006, right before the financial crisis and the housing market crash, which began in 2007-2008. Notice how everything starts heading south in 2007. The economy is in the toilet and sellers are realizing that they're just not going to get the prices they were hoping for, so they begin to concede on list prices. And the recovery in this ratio really doesn't start until 2012. And everything is going great, prices are going up, but not by a lot. People are happy, sellers are happy, buyers are happy, and so on until 2019. That's a good run of 8 years. And then all of a sudden you see, beginning in 2020, just like we saw in the median sales price chart, an unusual increase. That becomes even more apparent in 2021 and 2022. We even see the ratio jump into the stratosphere with sales over list price during those years, which we've not seen before in the ratio. The list prices are extraordinary, and buyers are paying them. Heck, they're paying even more. But now look at 2022 with a fresh set of eyes. Do you see any other year going back 12 years where you have seen such a spread in the sold to original list price ratio? Just look at that. The ratio hit its peak in April of 2022 when there was a rush of homes put on the market and when buyers were paying everything plus the kitchen sink. But now look where it's at. That's a 95.63 ratio for the first 2 weeks in October, and if that turns out to be correct for the entire month, we're back where we were in February of 2020. That's a spread of 5.14, and it shows a softening in the market. Now, just a note about the ratio, when people sell their homes below list price, they're getting less what they were anticipating. Quite often, a consistently falling sold to original list price ratio indicates that buyers are successfully negotiating a lower price, which means that sellers are losing confidence in their original price. A ratio above 96 indicates a strong seller's market when there's a lot of demand. But when the ratio starts dropping, especially when it drops down into the low 90s or even into the 80s, that's a clear sign that demand is falling and there's a softening of the market. Now, what this means for sellers is that you're going to have to price your home according to the current market, and if your home stays in the market too long, you may be looking at price reductions. And if you aren't looking at price reductions, you most definitely would be looking at seller concessions, such as paying for mortgagee and lender's title policy and search, or paying some or all of the buyer's closing costs, prepaids, and points if the buyer's trying to buy down the interest rate of their mortgage. And you may have to consider all of those things if you want to sell. Speaking of that, if you're thinking about selling, watch this video next.